You look at the stock market and man, it's just soaring, right? New highs left and right. On the surface, everything looks amazing. But today, we're going to peel back that shiny veneer. We're going to look for the unseen cracks in this bull market. And honestly, what we find, it might just change how you look at your own portfolio.
So, this brings us to this really provocative quote. It gets right to the heart of what a lot of us are feeling, right? How in the world can stocks keep climbing like this, at these valuations? And who is still buying? Well, like the quote says, the answer might be a lot closer to home than you think.
Okay, so all of these insights we're about to dive into, they come from this fantastic article over on philstockworld.com. And really, it's just a perfect example of the kind of sharp, no BS analysis they put out. It's exactly why we had to break it down for you in this explainer.
And just so you know who we're talking about, the site's founder is a guy named Phil Davis. Forbes has recognized him as a top market influencer, and get this, he's trained some of the top hedge fund managers out there. So yeah, when he points out a potential risk, you probably want to listen up.
All right, so with that context set, let's get into the main argument, starting with the very first major crack in this foundation, the idea that this whole rally, it might be a lot more fragile than it looks.
You look at the S&P 500 chart, and at first glance it's beautiful. But there's a key technical indicator, the RSI, the Relative Strength Index, that's flashing a huge warning sign. Think of the RSI like a speedometer for the market's momentum. And right now, it's redlining. When it gets this high, it means the market is overbought, basically running on fumes. In fact, we haven't seen it this stretched out since right before the 35% market collapse back in 2022. So yeah, that's crack number one.
But the second crack? Whoa, it's way, way bigger. We're talking $395 billion. That's the staggering amount of unrealized losses sitting on bank balance sheets, mostly from super cheap loans they made years ago. It's like having a giant credit card bill that you just haven't added to your budget yet. It's technically there, but you're not acknowledging it. By not booking these losses, the market looks hundreds of billions of dollars healthier than it actually is. It's a massive problem, just hiding in plain sight.
But you know what? Those cracks, they're just the beginning. The biggest issue, the real elephant in the room, is what the article calls the magnificent illusion, and it's all about the insane concentration of risk into just a few companies.
Oh yeah, you know these names. The Magnificent Seven. These tech giants have basically become the engine for the entire global market rally. Their performance has been so ridiculously strong that it's masking some pretty serious weakness just about everywhere else.
And the sheer scale of this concentration is just mind-boggling. Look at the NASDAQ. The top 10 stocks now make up more than half of the entire index's value, 52%. To find a market this top-heavy, you literally have to go all the way back to the late 1920s. And, well, we all know how that story ended, don't we?
So let's circle back to that first question. Who is doing all the buying? Well, look in the mirror. It's us. Every single time you put money into your 401k or an IRA that tracks the S&P 500, a huge chunk of that cash, we're talking 30, 40, sometimes 50%, is automatically funneled into these exact same few companies, which just keeps pushing their prices higher and higher.
And here's the proof of just how dependent the market has become. The Magnificent Seven, they were responsible for almost 87% of all the earnings growth in the S&P 500 last year. Seriously, let that sink in for a second. Without these 7 companies, the market would have practically zero growth. The entire system is basically resting on their shoulders.
Okay, to really see how risky this whole setup is, let's just zoom in on one of those 7 stocks as a perfect case study. Tesla. It's the ultimate example of how disconnected stock prices have become from reality. So at one point not too long ago, Tesla was trading at 248 times its earnings. 248x. Now, to put that into perspective for you, the historical average for the market is around 16. So this isn't just high, it's astronomical. But here's where it gets truly wild. While its stock was priced for this insane, explosive growth, its actual earnings, they shrank by more than 50%. Just think about that disconnect. The price says we're going to the moon, but the business reality says we're shrinking significantly. And this is the result of that disconnect. At its peak, Tesla's market cap was worth more than Toyota, Mercedes, GM, Ford, and Stellantis combined. One company, with shrinking earnings, was valued higher than almost the entire legacy auto industry put together. It doesn't make fundamental sense.
So, if it's not based on fundamentals, what on earth is pushing these prices so high?
Well, the answer is simple: liquidity. A massive, overwhelming flood of cash in the financial system. Let's follow the money.
We kind of touched on this before, but let's really break down how this engine works. Step 1, your retirement money goes into index funds. Step 2, those funds are forced, by their rules, to buy the biggest stocks. Step 3, this pushes the prices of those biggest stocks up, which then leads to Step 4, their higher prices make them an even bigger piece of the index, which then forces the funds to buy even more of them. It's a vicious, self-reinforcing feedback loop.
And it's not just our 401ks either. There are trillions more being pumped into the system. You've got massive corporate stock buybacks, huge government deficit spending, and the Federal Reserve draining its reverse repo facility, which is basically like unlocking trillions of dollars of parked cash and injecting it right back into the economy. All this cash has to go somewhere, and right now, it's just propping up stock prices, totally disconnected from what the businesses are actually doing.
Okay, so given this enormous disconnect between price and reality, what does history and what do the professional forecasters tell us about what might be coming next?
This table right here really puts it all into perspective. You look at key valuation metrics like the Shiller-Cape ratio, that's a fancy way of measuring stock prices against a whole decade of earnings to smooth things out. We're at the 97th percentile of the historical range. The standard S&P 500 PE ratio is double its historical average. I mean, by almost any historical yardstick you can find, the market is just incredibly expensive right now.
And this is what that might mean for your future returns. Goldman Sachs is forecasting that because of these sky-high valuations, the S&P 500 is only going to deliver an annualized return of about 3% over the next decade. Just 3%. That projection is in the 7th percentile of historical returns. That means that 93% of the time in history, you'd have been better off. After years of these amazing gains, we could seriously be looking at a lost decade for investors.
So here's the bottom line. We are in a market that's being driven by a tidal wave of cash, all concentrated into a tiny handful of mega stocks with valuations that are at historical extremes. And history tells us, again and again, that this kind of situation is not sustainable. But as the old saying goes, the market can stay irrational a lot longer than you can stay solvent, which leaves all of us without one final critical question: for how much longer?